Welcome everyone to the Putting Climate Talk into Action webinar. I'd like to welcome our panelists first of all. We have Jennifer, who's the head of ESG and public markets at PCI. We have Eugenia, who's head of ESG research at PGIM Fixed Income. Oliver, welcome, head of climate risk center and head of ESG research at MSCI. And Sean, who's the CIO at Margaret Cargill Financials. I'd also like to thank the audience for taking the time to join the session. I'm Timer Hyde. I'm the COO of PGIM, and we're going to go on a journey that is really a practitioner journey, focusing less on ivory tower thinking and some of the wider issues around climate change, but really to discuss how, as practitioners, to asset owners and investment management, and somebody who's at the heart of data analytics, really can help all of us think as practitioners how to integrate climate change and think about climate change risks and opportunities into portfolios. And that's the lens we'll take today. Maybe a good starting point for that is increasingly understanding and deepening our understanding of how climate change is being represented and reflected in asset prices and security prices. And we just did a report at PGIM called Weathering Climate Change, where we talked about 4 or 5 different factors that make climate change externalities increasingly, in our view, internalized within pricing. And that includes salience, just the fact that we've been at so many climate change tipping points that it is now salient in how markets are thinking about climate change. It includes data, which I'm sure Oliver will have much more to say about, and the fact that you now have the data to discriminate much more clearly between companies that are making the transition and companies that are getting left behind, and allowing you to separate. We have much more action from investors, and I'm sure Sean and Jennifer will speak to it, as well as from consumers that are forcing companies to think about climate change and affecting how well or badly they do. You, of course, have policy and regulatory action, most recently the Biden administration's kind of turning back and re-examining climate change more seriously. And then in the US, you have litigation. So there's a range of factors that's affecting how climate change externalities, often unlinked to markets, are getting reflected in market prices, both the public and private markets. And maybe I'll begin, Oliver, with you and get your perspective from your seat at MSCI on just a broad overview of how you're thinking climate change is fitting into the investment landscape.
Well, thank you, Timer. Sure. I think we've gone through a evolution of about 10, 15 years of climate change analysis in the financial industry. And the way I see the general journey is that it usually starts with emissions, because we all know that greenhouse gases are, the source of the effect of climate change that we're debating here. So, emissions, but within emissions, we've gone through, a series of scope 1 emissions that are the direct emissions, scope 2 emissions that are emissions that are induced by electricity consumption. And now just recently, we've, made huge progress on scope 3 emissions, which are sort of the remaining emissions in the supply chain that come from the products that companies buy, or the, flights that the employees take, or the cars that they sell, those kinds of supply chain emissions. Well, that is sort of the first starting point, I think, of any climate change analysis journey. And then I think the second step that investors usually take is what I call exposure analysis. So it's looking specifically at what are my exposures to, the perceived negative elements of a portfolio, in exposure to, emission-heavy products and things like that. And then there's a third dimension, which is almost like the real analytical dimension. And that has 2 parts. One is risk and one is impact. And impact is oftentimes measured in degrees Celsius or degrees Fahrenheit, mostly degrees Celsius, because the Paris Agreement and the climate goals with the 2-degree goal and the 1.5-degree goal are in Celsius. So that is usually the unit. And then risk is usually sort of a mispricing question, or maybe a scoring question, where the whole question of, exposure is transferred into what does that mean financially. So that's the general trend. In terms of geographies, I think we have Asia, who traditionally thinks about air quality quite a bit and links climate change analysis often to air quality. In Europe, I think it's related to the maybe the European Union being a regulatory body that in Europe, the discussion is mostly around regulations. And in the US, it's not black and white, but in the US, it's oftentimes extreme weather. And, we're seeing these record temperatures now on the West Coast in the heat wave. And just as an interesting point of fact, it's been debated a lot whether we're seeing record temperatures. And the former records are, pre the 50s, mostly probably with, instruments that wouldn't qualify as certified instruments today. If you want to have a World Meteorological Organization certified weather station, it's quite a long list of things that you need to comply with. So I think it's pretty safe to say that we're seeing record temperatures right now, and that obviously sparks a lot of things. And lastly, around asset classes, obviously equity is the starting point for all of these analysis, because the data available, but we have huge coverage in the corporate bond sector as well. I think many organizations now cover 10,000 of issuers. We're moving into the real estate space, into the sovereign loan space, the private assets and private loans space, and derivatives. So I think starting next year, we're going to have really pretty broad coverage of most institutional investor portfolios.
So maybe with that backdrop, Eugenia, you have a range of data providers. I think Oliver just gave a perspective on what's there. You and I have had a lot of discussions on just pragmatically what's doable and what's not doable at this point. Can you give us your sense as a bond investor at PGIM Fixed Income?
Well, sure. So I completely agree with Oliver that it starts with emissions, it starts with the basic data, but actually it's a lot more complex than this. And, as long-term investors, we are looking to navigate the opportunities and understand risks posed by climate change. And just to give you a few examples why it is so complicated. So on one hand, we have the physical risk. And if you look at the implications of physical risk, yes, there is implications for corporate debt, but it's much, much stronger for sovereigns or for munis or certain types of securitized assets. So you really need to undertake a thoughtful risk assessment, and the different providers, including MSCI, I definitely help with that. But the complexity is that these risks will be very different depending on on the geographic location and the impacts, and not only they're different among different countries, but also you can have very significant variation within the same market. Then when we talk about transition risks, again, we know that there are transition risks and they will be internalized at some point, but we don't really know at which point they will start being fully reflected in market prices. And partially this is because we have the regulatory, the governmental, the societal response to climate change is not certain yet. So we know where we are, we know the direction of travel that we need to go to, but we still have I don't think too many details on how exactly we are going to make it. And quite honestly, if we are going to make it at all, because if we look at the recently published IEA's net zero scenario, it illustrates just how challenging it will be for the humankind to get to 1.5 degrees. So for fixed income investors, so we have to take into account of those. And I would certainly agree that, with the better disclosure and analytics, there will definitely be a better ability by investors to quantify climate risk and differentiate between different companies with the same industry. And this kind of relative valuation tends to really lead to a repricing of assets. So that's going to happen, but I think it will take some time. Also on the policy and regulatory initiative, things like the tighter emission standards for automotive industry, fuel tax proposal for aviation, carbon levy on carbon intensive imports, phasing out free carbon credits under the existing emissions trading schemes, incentives for low emission fuels. This all will make an impact on credit assessments and valuations. And at the moment, it's quite separate, it's quite disjointed, but as more jurisdictions start adopting comparable policy initiatives, then we will see a more complete repricing of transition risks that is likely to occur on the global scale. So and the final point I will mention is what we're really observing currently is a huge development and change in preferences of investors. You mentioned investors and consumers, Timer. From my position, I see a huge change in preferences for investors, which are starting to catalyze repricing of climate risks. And as investors are setting the net zero goals, as they're seeking decarbonization of their portfolios, and they're doing it for two reasons. One is to protect their assets from carbon-related risks. The other one is also to create incentives for carbon-intensive industries to decarbonize, to increase the cost of capital for carbon-intensive industries. So that will definitely have an impact on the cost of capital of these issuers. We are seeing the gradual sort of incorporation of climate risks, but it will take time before we see the full impact across, different fixed income asset classes.
Sean, I mean, just speaking of investors from your perspective, and broadening it beyond fixed income to everything you have in your portfolio, how are you all thinking about climate change and integrating it?
Yeah, no, thanks, Timer. We've been focused on not investing in, for example, upstream oil and gas, coal sands, things that are carbon intensive for some time. And that includes normal divestment, but it also includes not making active investments into those industries that are still seeking old technologies or continuation of the same. And then we've been putting a great deal of money over the years into new and cleaner forms of energy, for example. We've invested in a Kenyan wind farm, which has produced good results for us. We also do energy efficiency projects, decentralized solar and companies that support that. We're focused on controlled environment food type products, such as greenhouses that look at lower water waste, better use of pest control, products, etc. We've been focused on transportation for a while, from electric to hybrid vehicles, etc. We're starting to get deeper into things more like ocean farming and trying to understand the pros and cons of good, bad. But, we've been in this space for a while. And interestingly enough, at least on the equity side, there's been a reasonable availability of unique ideas that are both, in our mind, good for the environment, but also provide attractive returns. So, it hasn't harmed our portfolio to focus on these. And also staying away from some of the dirty industries has certainly benefited us over the last decade as well. So we're happy with the results, both from a financial standpoint thus far and from feeling good about how we're making money, in the environment, I guess.
And Jennifer, across the public markets, what's your perspective in BCIs?
Yeah, thank you. And maybe just to set a bit of context as well, just to explain the difference maybe with Sean's approach, is that we have not taken any kind of divestment action. We're a very broad, diversified investor, across asset classes. And we have not taken that approach to date. So it really is about integrating ESG and climate more specifically into our investment decisions, as well as using, all of the regular stewardship tools that we have at our disposal. That being said, we do have a climate action plan that has, 4 pillars to it, and I'm sure we'll get into, some of those details later. But one of the key pillars of that is to seek out some of the opportunities. Right. So it's not just about managing the risk of climate change, which we absolutely have to do with such a large diversified portfolio. But also we want to capture the upside in, all of the industries and technology that we're going to need to actually, meet the Paris goals. So we do have a thematic portfolio, for example, that has a big focus on energy efficiency. It's been one of our best performing funds, and it has been growing in the last few years. So that's just one example. But I would also say, when just to kind of build on what Eugenia was saying, especially investors really are driving, a change in the landscape here from what I see, and it's across asset classes. And I can say that because of, us trying to seek out some of these opportunities and realizing just how expensive some of these assets have become, and to the point where we are priced out. So it's actually becoming harder to find the opportunities, especially in more of the illiquid asset classes. So definitely, could use some more supply there. But we're also thinking about how we actually invest in the transition itself. So, not just buying those clean green assets that everybody else wants. But what can we do to actually transition, some of the dirtier assets, right? Because if we just sell, we're not actually going to make a difference. If we stick with an asset and we're able to actually transform it and drive it towards net zero, then that actually has a real impact on the emissions profile of those assets. So we're trying to think more and more about how we can do that, across all of the different asset classes, and really see that reduction in emissions, which is ultimately where we need to get to as a globe.
Well, I love those two perspectives, and the sort of debate between kind of, where's divestment and where does engagement work, and how they interrelate. And maybe that's a good segue to something, Sean and Jennifer, I wanted to ask both of you, and then get Eugenia's perspective as an asset manager. But maybe take a step back and walk us through your climate change integration efforts. And maybe, Sean, if we can start with you, what was sort of the biggest challenge you faced, and how did you sort of figure out a way of kind of overcoming it in terms of sort of taking this amorphous topic with kind of, nonlinear tail risks and so much uncertainty, and sort of bringing it into the portfolio and a way of thinking?
Yeah, no, thank you. And maybe if I can, I'll just comment on Jennifer's last comment, and then I'll answer your question. I do agree engagement is better, than divestment. However, not everybody, including us, is set up from a governance standpoint, from a personnel standpoint, to engage. We engage mildly where we can, but therefore, at a minimum, we focus on divestment. We'd rather others, like Jennifer, own these securities and therefore engage. So I just want to put that one to bed. I do agree, Jennifer, more with your approach than with ours, but we're just not equipped, to engage on that level as well. Plus, given our size, it's just not always the right way to go. In terms of process and integrating items into our view, if I leave climate change aside for the initial point, as Timer had indicated, we've been working on mission-aligned investing for a while. We call it mission-related investing. You can call it ESG, you can use whatever moniker you want. But the idea is that we have a very specific mission, and we're looking for investments that are aligned with that mission. So environment has been part of our mission since the beginning. However, specific aspects of the way we make grants to help support the environment have not been specifically around carbon production, carbon sequestration, climate change in general, because we're not focused on policy and certain other items, just as the nature of who we are. However, because all of our investment processes are set up to integrate mission-related factors into every decision we make, it was pretty natural here as we embark on climate change as well, being yet just another piece of what we discuss. Then, Timer, getting to your point about it's hard to not integrate the risk and not to think about it. And to be honest, what we find is when we go to talk to individual companies or managers, depending on whether it's direct or indirect investing, for us, we sometimes get the what's ESG? What's an ESG policy? What are you talking about? And at a minimum, that's not only a flag, I mean, that's a red flag. It's a non-starter. If people don't understand the challenge and the problem, then it's just not where we need to be. So I think some of that is straightforward. However, then we've got to choose, again, industry by industry, where are the risk appropriately taken into account? How are they going to go? And it's hard. But again, that's investing. So we recognize over the last couple of years, we need to be more specific and deliberate about climate change being an aspect of the diligence that we complete on any potential investment that goes into our portfolio.
Very, very practical, very, very doable, and very interesting. Jennifer, what's your take? How do you all pursue this?
Yes, and so we did develop a climate action plan that we published in 2017. And it's not because that's when we started working on climate change. We had really been looking at climate change, for over 10 years at that point. But what we really felt we needed at that point in time was to bring everything together into a more comprehensive strategy and approach. So just as you approach, at any kind of investment strategy, you want to make sure that you think about it kind of holistically and how you're going to implement it. So we had taken these pieces that we had been working on, we'd been doing some scenario analysis in the early days. We had certainly been putting a lot of effort into our, proxy voting and engagement activities. But we really needed to broaden it out from there and, look across asset classes, but also bring in our investment strategy and risk team, which has really, built itself up over the last several years and has been developing capacity and capabilities in this area to really make sure we were bringing everything together in a coordinated way. So as I mentioned, the strategy has 4 pillars to it. I mean, we do want to integrate climate change into all of our investment decisions. Obviously, based on materiality, it's going to be much more material to some investments than it would be to others. But for example, any active position, and I probably should say, we do manage quite a bit of money internally at BCI. So any active position, it's my team that's really working with the investment teams on integrating, any particular climate change risk into that decision. Or if it's, an infrastructure private equity investment, there's going to be an analysis that goes up to the investment committee. So it's very intentional. As Sean had mentioned earlier, I think you have to have that intention, or it's easy to kind of slip away in some cases. So we also want to manage the risk, at a total portfolio level. So that's where our investment strategy and risk team comes in. We do want to seek opportunities in the space, and we want to continue engaging and advocating. And that's both with companies in our portfolio, but also on the public policy side, which I think is really crucial for investors to really get engaged in. So it's really a comprehensive strategy that we're trying to tackle, from all angles. I guess, to share some, learnings or challenges along the way. I mean, I would definitely recommend if people are going down this path, to make sure that it is supported with training and education, because, many of us work in larger organizations. It's not just, oh, we have a new strategy, here you go, and you roll it out and everyone, knows exactly what to do, especially when, climate change is it's not a skill set that everyone has. So to really make sure it's supported with some of that foundational work, I think to, bring all the investment teams along, make sure everyone is on the same page. I think, we're doing that a little bit, later down the road, but I kind of wish that we had done that up front. So that's certainly one thing that I would share with your audience, is to make sure that, it's not just a standalone strategy, that you actually have a plan, how to implement it and how to get everyone engaged in it, and make sure that everyone is on the same page.
Just a quick follow-up, maybe Sean, to you and then to Jennifer on, climate change factors that affect the risk-return characteristics of an investment you're looking at versus climate change factors that may be good for society, the world, the climate, but may not affect risk return. Do you make a distinction between those two as you think about a particular security or asset and whether to purchase it or sell it?
We're rather analytical chaps, and I would assume Jennifer would say the same thing. So we try to parse things down to the smallest or the least common denominator, if I can use that phrase. However, ultimately, I don't know that it matters that much. The differentiation, we differentiate for the purposes of understanding. However, if we find out we can add a positive attribute to society and it's not going to cost us, or we don't believe it's costing us, then it's a no-brainer. If there's something out there that is associated with a cost, lower return, whatever the case may be, we have the ability then to analyze that for consideration in some small ways. But if we're going to take something that has a lower risk adjusted return, we've really got to believe in the story. We've got to believe in the benefit that we're capturing, and we want that benefit to be hugely aligned and accretive with our mission, because we can't solve everything. So when things start becoming less about risk adjusted return, then they really need to jump off the page at us as this is something that we can do better or as well through an investment market versus through a grant. So, and those are the type things we trade off, but we're open to anything. We want to implement our mission, but we don't want to do it at the expense of return. If earning the return and making a grant is the better way to accomplish our goal, then we will. So we try to make judgments across the spectrum.
Jennifer, any nuance to that from BCI's and your approach?
Yeah, I mean, we are under some very specific legislation here in British Columbia, which is very clear that we need to act in the best financial interest of our clients. And that is the exact language, best financial interest. So it's very specific. So I would say on an individual investment level, yes, the returns have to be there. We cannot take a lower return. Where I would say we try to address the broader, more systemic issue, is in terms of our policy work, which is why I think it is so important for investors to be involved in that conversation, because on a one-time investment level, it's a very limited impact. Whereas if we can really push the policymakers to ensure that there is this level playing field and that assets are priced accordingly, then that is going to flow through to all of our investments. So maybe just a distinction there between individual investment risk and systemic investment risk.
Yeah, and Timer, I'll note we're not bound by the same restrictions that a lot of other institutions in the US and then also in Canada and abroad are bound by. So we can consider some of the things I stated. However, we believe that having a risk-adjusted return is a critical part of making sure that something is going to not die on the vine, that it's going to continue. So we're very, very careful before we go down a path of something that appears non-market rate. And we really want to believe that it's going to enable a situation that will ultimately get to an investment that is market rate, where more capital will come behind us. We're not into granting with our investment portfolio.
Very clear, very, very clear. Fascinating. Eugenia, maybe one very quick question actually two questions. One is on engagement as a bond investor. You guys almost have $1 trillion under management. How do you think about engagement? Because I presume that's easier on, say, the equity side or direct real estate than in fixed income. And then maybe if you can follow on from that, can you just give us a quick snapshot of how you, at PGIM Fixed Income, you've integrated climate change into your investment thinking, and in what ways is it practically possible and where is it hard versus easy?
Sure. On the engagement side, yes, we are bond-only investors, which means we don't have an equity arm, which means that unless in some very specific circumstances, we don't have the lever of voting rights, to be able to support our engagement and stewardship efforts. So what we do have is, as an active manager, we do have access to companies and to sovereign issuers. So we have the ability to put the topics on the table and generate the conversation and discussion and really focus on understanding the management point of view there and also their strategy, be it on climate, be it on environmental, social, and governance issues. So we really have the ability and the willingness to have that conversation. And it's extremely helpful in our research as well, because as we'll probably discuss later, it's bound to come up about data and information. And that's something that unfortunately in fixed income space, we are still missing in very large, for very large proportions of our portfolio. Also, as an active investor with a very, I would say, robust ESG integration approach, as well as our framework with ESG impact ratings, where we are assessing not only the impact of ESG topics on the issuer and, on the credit, but how our investments impact the environment and society. We have the ability of bringing this dual perspective to the table. And we would discuss the credit material ESG issues, and then we would focus on the impacts, the negative impacts that issuers have, how they're mitigating those negative impacts. We would focus on positive contributions that they are making and sort of how they are working to enhance those. And using the framework and our internal ratings, we can really highlight to the companies as to where they could be, they could face, higher cost of capital if they don't address some of the issues that worry us and that lead to lower internal ratings in our methodology. So there are ways of doing it. However, I would say that definitely without the the power of voting rights, your toolbox is rather limited, and this is where divestment or non-investment, rather, sort of forfeiting the opportunity to invest, is actually quite a powerful tool and something that definitely catches the attention of the issuers. So the more of our clients care about ESG, the more our clients invest with ESG considerations in mind in dedicated ESG strategies, the more power we have, and sort of the better is our argument when we talk to the issuers about the cost of capital. So that's the first part of your question. The second one, how we integrate it. I would say that it's very briefly that this is a combination of top-down, but also primarily the bottom-up approach. And I just must say that because it will sound a bit controversial, but if I look at all the available guidance and tools, when it comes to climate risk analysis, it kind of focuses on top-down analysis, so the assessment, monitoring of portfolios on certain carbon metrics, as well as scenario analysis. And in our view, yes, it is definitely part of the solution because it helps to identify the potential risk exposures. But then it's only a starting point because it allows us to focus, sort of identify the areas of focus, but then we need to dig deeper to arrive at kind of decision useful investment insights. And to us, those decision useful investment insights really come from the bottom-up analysis because, and it's unfortunate that it's overlooked in current climate-related discussions, but the real integration, in our view, starts with assessing climate risks as well as climate opportunities at the individual credit level, looking at their idiosyncratic exposures to physical and transition risks. And at PGIM Fixed Income, this is done by our credit analysts, by our economists, with the support from my team. And when we do it this way, that allows us, even when we then do sensitivity analysis or scenario analysis, it allows us to focus on the specific sectors and issuers, to choose the scenarios, which will definitely vary by sector and by region and even at times by issuer, just because we need to ensure that these scenarios reflect in the best way the most likely channels through which that transition risk may manifest itself at a particular issuer or for a particular industry. Just a very quick example. For utilities, for example, we will be stressing the terminal values of fossil fuel powered electricity facilities for forced early closures. For energy sector, we will be stressing the break-even prices or spreads for crude production and refining under a scenario of prolonged low energy prices. For autos, we will be stressing differently. We will be stressing issuers for the cost of the accelerated tightening of emission standards, plus any material fines for non-compliance. For industrials or issuers in markets exposed to carbon pricing, we would consider the impact of higher carbon prices. So that analysis is going to be different depending on what those risk channels are and sort of what we want to stress test for. And then we have to put it all in the context of our entire credit analysis, because understanding climate risk is one of many factors for successful investments. So to us, and maybe just again as another example, if we have an issuer with a lower carbon intensity versus comparable peer where intensity is higher, and all else is equal, then of course the preference would be for a low carbon intensity issuer. However, in real world, all else is typically not equal. So, and in a case if we have a less carbon intensive business, but with considerably higher leverage, then it will still pose higher credit risk compared to a more carbon intensive business with considerably lower leverage. So we have to put that climate risk analysis in the context of the sort of overall investment assessment. So so to us, we do use top-down analysis to understand the exposures in our portfolio, but it's the bottom-up analysis. It's focusing on individual credits, is sort of focusing on the issues and risks and opportunities which are specific to individual sectors that provide us with the most investment relevant insights when it comes to climate risk at this stage.
Oliver, it's sort of become clear that for Jennifer and Sean and Eugenia to excel at what they're doing, you really need a solid underpinning of data and analytics, and really you can't distinguish between securities and companies and assets if you sort of don't have data that's granular enough to sort of tease apart, who's winning and losing in kind of the climate change transition. So probably a good segue to that's the sort of airy-fairy tools that are needed to look at 100-year scenarios, and more for actual practitioners. What does MSCI offer? What do you see as kind of the waterfront of climate change tools that a practitioner can use today to understand and grapple with these issues?
Yeah. Yes, Timer, maybe building on what everybody said. First of all, I think it's important to recognize that climate change analysis, as has been stated before, is scenario analysis. So what that means is that usually, there are some limitations to, let's say, the back testing or the verification of what you can do. And, that's something I, as, let's say, a science guy, would like to change. I'd love to change it. I would love, all of our models to run on machine learning, if possible, on training data, but it just isn't possible. Because we didn't have climate change in the same way for the last 30 years. So if you were to do that, you would see zero signal almost, and you wouldn't have any analysis. So I think we have to live with the fact that what we're measuring here is not risk in the term that, we can measure risk as it had been perceived, but we're really measuring uncertainty. A second thing, building on what Eugenia said, yes, it's a big, big, big bottom-up data exercise. So just to mention a few things that we're doing, we're collecting asset locations, so production locations, offices, warehouses, oil drilling sites, all sorts of assets for, all of those issuers that we're covering. That's a huge exercise by itself. We use patent databases to look at, how companies are positioned with technology opportunities. Who are the owners of the technology of tomorrow? We do a lot of data collection related to Scope 3 data for estimation models of Scope 3 footprints. For example, we track the, let's say, for example, the type of cars that companies are selling, or the franchises that they operate, these kinds of things. And just recently, we have, gone through a huge exercise of recollecting the climate target data of companies. And those data points then flow into our more complex climate value at risk and implied temperature rise models. Now, on the tool side, I think the most popular tool lately for financial organizations has been our net zero target setting tool, because I think that's one of the major questions a lot of our clients are asking themselves. What does it actually mean? What would my decarbonization rate be? What would be the target year that I could potentially even consider or announce? And then how much of the decarbonization might happen intrinsically in the portfolio by the decarbonization of the companies, and how much would I have to, and that's one of the major questions, how much would the sort of external, meaning by reallocating capital, how much of that decarbonization would happen from there? Then just more on a strategic level, our net zero investment framework, I think, has been very helpful for many organizations who've been starting to do this. Obviously, a lot of organizations now have TCFD reporting solutions for those organizations that want to write a TCFD report. And I think we're sort of moving from, let's say, the reporting tools slowly into the risk management and portfolio construction tools. So that includes obviously things like benchmark comparison, attribution analysis, and then the more complicated risk management tools. So it's really quite a broad range of tools that people are employing, and it's becoming more and more difficult to navigate that space and to see which functionality is available in what software or approach.
Oliver, I know in our conversations with clients at PGIM, we hear a lot about the consistency of data that companies are providing, the regularity with which they come out, the consistency of the metrics, and how they're not consistent and not regular and often not transparent and often a little greenwashed. How in your seat as sort of one of those gatekeepers of that data and collector of this data, are you thinking how we create better consistency and transparency?
So in my view, consistency is absolutely key. Because if we don't have consistency, it will be very difficult to navigate that space. If every service provider has different data, it will become totally impossible to navigate the data space. I think there are let's say two sides to the story. One is maybe consistency on the input side, meaning what data do we have on, let's say, asset locations, on corporate disclosures and things like that. I think on that side, consistency is almost a no-brainer. And we just need to really create standards, and whether these are industry standards or regulator enforced standards, I don't really care. On the output side, I think we also need standards. And at least I can speak for my team, we're trying very hard to comply with any standard that is emerging. And some of those changes are quite painful. And you can probably imagine that a team that has built models is usually quite reluctant to make changes, but we're really pushing that through. But I would like to say that on the output side, total consistency also provides systemic risk and maybe a barrier to innovation. So I think on the output side, I think we need to have a little bit of patience, probably, for that consistency process to turn out. But I can just mention one consistency effort that the portfolio alignment team of the COP26 group has just come out with a report on these temperature metrics and the 22 recommendations. And I think this is a great example of convergence that's already happening. And I really hope that all data providers will try to comply with all of these 22 recommendations, because they're very broadly supported by many stakeholders. And I see that happening for many of our metrics over the next 10 years.
Jennifer and Sean, just speaking of tools very, very quickly, if there's one tool each of you might want to mention that you use in your climate analysis, would there be one that you'd recommend or suggest, if there are any out there?
It was certainly hard to just say one. but we really try to ground all of our work in the TCFD and the recommendations, for asset managers and asset owners in particular. So in terms of, the goal that we've set for our equities portfolio, for example, is based on the WACI, the weighted average carbon intensity, which is the main tool or measurement that is recommended by TCFD. But yeah, we would have many tools that our investment strategy and risk team as well are really building internally, which I know a lot of people don't have the capacity to do. But yeah, it's an extensive effort.
Yeah, I would say we try not to reinvent the wheel. We try to grab whatever's available in the industry, from working with MSCI, Gen Iris metrics, UNPRIs, and we try to utilize standardized metrics in many of them so that we can measure our own portfolio, again, either on an indirect basis or direct basis, depending on how we hold the exposure. So we're big on trying to come up with an estimate of everything we care about, all the way from mission fit to impact that we're getting across a whole grid of metrics. So we utilize, again, just standard off the shelf stuff. And we try to plot over time, to help make sure that we're not just trying to compare ourselves to peers. We're trying to show absolute improvement in each of our metrics over time. And climate change is no different. So
I'm going to hit a couple of the questions. We've got a bunch in, and I'm not sure we can hit all of them, but I was hoping to hit a couple. And maybe one, Jennifer, I think this one may be a good one for you, but on how do we make industries more accountable for carbon equivalent emissions? Is net zero possible considering the continuous increase in consumption per capita?
Yeah, I mean, this is the question that we ask ourselves almost every day, because regardless of the actions that we take as an individual investor, there is going to be systemic climate risk in our investment portfolio, no matter what. So it's that constant question of, yes, how do we get there? How likely is it? And what can we do to help get there? So in terms of, keeping industries accountable, I mean, we have to use our stewardship tools. So that's, voting specifically. We've really beefed up our proxy voting guidelines to address climate in particular, and we have been voting against directors for insufficient climate data as well as inaction. So that's been in effect, and we are an active member of Climate Action 100 Plus, which I think has been quite successful in terms of providing a very clear signal to the market and really to the top emitters that this is the expectation from investors. We are all in it. We have very diversified portfolios. So if we're actually going to get there, this needs to be a really concerted effort by everyone involved. So I think investors from an engagement standpoint have been very clear and very public about that. And the fact that this is a long-term engagement, in terms of Climate Action 100 Plus in particular, companies know that they are going to be engaging with this group, for at least 5 years. And I certainly wouldn't be surprised if it gets extended. But it's been very effective in my view, and really has to touch on all industries that really need to come to the table.
The central banks globally seem to talk a lot about climate risk. Is another question we just got in as a topic. But what really is their role? Maybe Eugenia, from a bond fixed income perspective, you can tackle that one.
Definitely. Well, we actually had a recent paper by our chief European economist, Catherine Nice, on PGIM Fixed Income website, which specifically addresses this topic. Actually, if you read this paper, the view is that the central bank action on climate change is actually wholly consistent with the traditional view that central banks should facilitate the efficient allocation of resources. and they're most effective when they're free from short-sighted political influence and sort of trying to achieve longer-term societal objectives. So what the banks can take a number of steps that could be very helpful and influential. And first and foremost, is of course the stress testing. And ensuring that there are adequate capital buffers and monitoring institutions' capital allocation. And that can support then the evolution of monetary policy, which is what we need to meet the objectives of fighting climate change. So there are many steps that they can take, from taking a leading role in setting financial regulation, ensuring that prices reflect the complete information to incentivize this desired investment behavior, mandate the disclosure of climate-related risks, and then help to drive the investment behavior towards a green transition. So quite a big role, but obviously each central bank has its own mandate, and they need to navigate this environment.
A couple on data, Oliver. Maybe I'll direct them at you, which is climate value at risk. Is that a new tool that should be used? And then kind of just ESG reporting software, is it getting better?
So climate value at risk, from my point of view, it should definitely be used. And the reason is because when we look at practitioners working with our data, let's say day-to-day portfolio managers, it's quite obvious that it's their objective to create return, and it should be. And it's important. And so I think when they work with ESG data, I think it should be aligned with that objective. And oftentimes it's quite hard to make that link between their return objectives and the ESG data that you see. And I think a mispricing assessment and a value at risk approach is actually something that they're doing in the back of their heads when they look at ESG data. And we're just trying to ease and simplify that process. Now, obviously, these models are complex and hard to understand and have their limits, and usually are representative of a certain scenario and our underlying assumptions. But those then need to be assessed by the portfolio manager in how they are aligned with the view of the portfolio manager. Tools on ESG data, yeah, they're popping up left and right. I mean, I can't even track the market and what's happening. I mean, I think soon, you will have ESG data on your mobile phone when you unpack it from the mobile phone store. So I think, that's just an exploding market. And the main reason is because ESG data is really not that different in a way from financial data overall. So it's quite easy to integrate in existing tools. So that's why I think, as the adoption is, growing, I think we'll see a lot of development here.
Maybe time for one final question that we can sneak in, and maybe Jennifer, you could say something, and then Sean, which I thought was a good question, which is, how can we best show the cost of not taking action on climate risk?
Yeah, I mean, I would agree. It is a great question because it speaks to the systemic nature of the risk, which, I hate to sound like a broken record, but we are going to be facing the systemic risk for the rest of our time trying to manage money here. And I think we do have some of this information, right? There have been studies into, what is the cost going to be to GDP if we continue on these different paths. So I think especially following, something that the world has experienced like COVID, which, you really saw that kind of shock to the system. I think, using the same kind of analogy with climate change to say, if we continue on this path, this is going to be the impact on GDP. So if you think that it's not going to affect us, it absolutely is going to affect us, and there's going to be nowhere to go. From an investment standpoint, because it is so systemic in the portfolio. So I feel like some of that data around the impact on GDP can help bring to light for people, just just to what extent this is going to affect the economic system overall, which we are all very much dependent on.
Yeah, I agree fully with Jennifer. I don't have much to add. I do believe long-term ex post, it'll be very clear. Near term ex ante, it's very hard to get people to look at analytical data and buy into the challenges or the immediate cost, right? And that's really our challenge, is showing, the right risk, or when you don't realize the immediate risk or the immediate pain, in an investment or a portfolio, or a company skates by doing the wrong thing, for a while. Eventually everything will come home to roost. It's just may take longer in some scenarios, but you need to be there early enough in advance. You can't wait until it happens and then try to jump on. So.
Thank you. I think we should probably wrap up at this point. I will say kind of one of my biggest takeaways has been that the evidence, the data, the investment processes now exist for any investor, whether they have an explicit ESG mandate, whether kind of they're risk return fiduciaries. It really speaks to the fact that it's an imperative to integrate climate change risks and opportunities into your portfolio. And I'd like to thank Jennifer and Sean to kind of sharing the investment journeys as investors. Eugenia, your perspective from PGIM Fixed Income, and Oliver, your perspective from MSCI on kind of the data and analytics underpinning it. It's much more to discuss, but thank you all for the discussion, and thank you to the audience for joining us today for this conversation.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.